Welcome back to today's Market Explainer. Look, given the setup today, you probably already know the vibe. Things are looking a little gloomy on the tape, but honestly, there is incredible opportunity hiding in the data if you just know where to look. We're breaking down the action for July 23rd, 2026, and bringing you a witty, professional, and completely data-driven look at exactly what moved your portfolio today, and more importantly, what's going to drive it tomorrow. Right off the bat, let's look at the actual damage. The Nifty dropped about 126 points to close at 23,869, while the Sensex shed 364 points, settling in at 76,391. So yeah, we are now looking at a fourth consecutive down day, but here's the really fascinating part. This isn't widespread domestic panic, not at all. This is a market that has effectively been taken hostage by external macro factors.
Okay, let's dive into this top-down funnel to make sense of it all. We'll start with hostage to crude, move into the institutional tug-of-war, drill down into some Q1 reality checks, check out sector rotation, and finally, lay out tomorrow's playbook.
Section 1. Hostage to crude, the master variable.
Right now, oil, not earnings, is absolutely the master variable dictating the direction of our indices. A fresh round of US and Iran escalation has kept Brent crude strongly bid. Basically, geopolitical tensions are reviving those perennial supply shock fears around the Strait-of-Hormuz. Now, objectively speaking, this creates a massive divergence in the market. On one hand, it immediately pressures the rupee, aviation stocks, and oil marketing companies like BPCL and HPCL. But on the exact opposite side of that trade, it provides an incredibly clean tailwind for upstream players like ONGC and Oil India. For 4 straight sessions, this single commodity has been driving the bus.
Moving on to Section 2, the institutional tug-of-war. An immovable object meets an unstoppable force. And this perfectly illustrates the coiled dynamic capping our upside right now. Foreign institutional investors dumped a heavy 2,999 crore in cash today. But look at the domestic institutional investors, buying 2,947 crore. Those massive foreign outflows were almost exactly absorbed by domestic institutions. This is the 4th straight session we've seen this exact pattern play out. Domestic money is just stubbornly cushioning the foreign exit, creating this perfectly coiled setup that absolutely refuses to let the index break, but totally caps any upward momentum. It's wild to watch.
All right, Section 3, Q1 reality checks. Let's get into the earnings drama.
Let's look under the hood at the specific earnings that acted as the internal market engine today. First up, we've got the IT bellwether Infosys. They reported a consolidated profit after tax of 7,775 crore. Now that's up 12.3% year over year, but actually down 8.6% sequentially. Revenue came in at 48,211 crore, which is a solid 14% year over year bump. So it's a steady, inline print, but frankly, it's just uninspiring. Because of that sequential dip, the read-through for the wider IT tape, Wipro, HCL Tech, Coforge, is neutral to mildly soft. Now, here is a frankly painful reality check for retail investors. Check this out. SRF posted a massive 76% year-over-year jump in profit after tax. IndusInd Bank, a 72% jump. Incredible numbers, right? Yet, SRF crashed 8.5% and was literally the day's worst F&O loser, while IndusInd Bank dumped 6%. Both of them met fierce, unrelenting profit booking the exact moment those numbers hit the wire. So what's the crucial takeaway here? It's that guidance, not the shiny headline, actually moves the needle. SRF is a great cautionary tale here. Their board actually cleared a massive 250 crore capex, and revenue was up 32%. But management guided for a softer Q2 and Q3 because of pricing and volume pressures. The market completely ignored those great headline numbers and aggressively sold the forward guidance. Same story for IndusInd. The market wants consistent proof that their governance and accounting cleanup is actually durable before sustaining that huge 18% one-month rally they just had. Section 4. Sector rotation. Auto surge and the scuttlebutt fades. So where's the actual money going and what's just noise? Well, with crude hitting financials, we saw a really clear defensive rotation into autos and wealth management today. Hero MotoCorp was the top F&O gainer, up 3.7%, and Bajaj Auto rallied 2.6%. Both are riding this huge wave of festive demand optimism. Nuvama also jumped 3.4%, pretty much proving that the affluent wealth franchise remains an absolute market favorite during these turbulent, choppy capital market cycles. But, while real money was rotating into those autos, the retail rumor mill was going absolutely crazy on X and Reddit regarding 2 specific stocks, Vodafone Idea and Data Patterns. The chatter is entirely focused on
AGR relief for Vodafone, and massive new defense orders for data patterns.
Here's your professional reality check on those rumors. The probability of near-term truth for both of these, pretty low to medium. Vodafone Idea is just perennial speculation. There is absolutely zero fresh official signal from the government. As for data patterns, there's no exchange filing to confirm a specific HAL-linked order. The stock spiked over 12% yesterday purely on the buzz and violently reversed to close down 3.7% today. The verdict? Treat these pops as fading buzz. Without official exchange filings, these are just low-probability gambles. Don't get caught in the hype. Which brings us to Section 5, tomorrow's trading playbook and prepping for July 24th. First things first, respect the earnings calendar. Tomorrow is a really heavy slate. We've got Q1 results hitting for NTPC, SBI Life, Bank of Baroda, Tata Consumer, and quite a few others. This means single stock gap risk is exceptionally high at the open. Whatever you do, do not get caught offside holding unhedged overnight positions in these names. So here is your concrete 3-step checklist for tomorrow's open. Step 1. Monitor Brent crude. A move through the low 90s is the trigger that will immediately hit the rupee and the OMCs all over again. Step 2. Watch those FII cash flows. If we see a 5th consecutive day of heavy foreign selling, it is going to severely pressure market breadth, no matter how much the DIIs try to buy. And step 3, keep a very close eye on the Nifty weekly options expiry. Max pain is sitting right around that 24,000 mark.
Now, if you're looking for a structural idea to focus on, consider this setup: a long on ONGC. Why? Because it is literally the cleanest expression of today's dominant macro variable. Firm Brent crude directly lifts their upstream realizations. But as with all things in the market, respect the risk. A sudden crude cool-off, if U.S.-Iran tensions de-escalate, could ruin the party. So keep the structure-defined risk. Finally, just a really quick corporate action update. We're keeping an eye out for historically large final dividend declarations from Bosch and Union Bank in this late July window. Just make sure you personally verify these ex-dates and the exact dividend per share directly on the NSE or BSE circulars before sizing any dividend capture trades. There are no confirmed buybacks or splits for tomorrow. And as always, just a quick reminder that this explainer is personal research for educational purposes only, definitely not investment advice.
We're going to leave you with this final, kind of provocative thought. We have this incredibly coiled FII versus DII setup, capping the index while the pressure just keeps building. If crude suddenly cools off and that massive macro headwind vanishes, will this coiled market violently snap upward and finally break 24,100? I guess we'll find out. Keep a very close eye on the tape tomorrow. Thanks for joining this explainer, and we'll see you for the next market update.